Hi, it's Larry Gaines from PowerCycleTrading.com. In this video, I want to show you really an amazing option strategy, and it's a way that you can, lower your risk and be structured or set up for a trade that can offer you huge returns. So in this example, I'm going to show you a trade setup that we did today and adjusted it into what we call a butterfly, and we have a trade setup that has potential for 35-to-1 return on your capital at risk. So first off, the trade was on QQQ. So key area of support here coming into today was this 298 area here. So when the market opened up, we broke down below the 310 here a couple of days ago, came down to 298, bounced off of it. So we were looking for a break of 298. So when it broke 298, basically broke 295 right here, I sent out an alert. We have an alert. I have an alert service for trade setups, and sent out a trade here to go short QQQ, and we started the trade off by shorting it using a put debit spread. So by doing that, we went into the trade with a really defined risk and a good return. But what we did to make the trade even better with lower risk is we towards the end of the day adjusted it to a butterfly. So let's take a look. So the original setup was when it broke this 295 area here today. We went out and we bought this week the Friday expiration, the 13 May 298 put, and sold against it as a spread the 13 May 290 put. So a $8 wide put debit spread for the total risk of $280. Now, this trade here, you're risking $280, but if it closes on Friday below the 290 strike here, this has a really nice return. This would make $520 on that risk of $280. So that's about 185% return. But the plan on the trade was that if we did get a flush down, which we did, was to look to sell against it a bull put credit spread when it was trading as close to the lows as we could get, and that would adjust down our risk and that would increase our return as well. So this is what we did. So when it flushed down here and it was trading around 292 or 291, actually lower than 292, sold the sold the 13 May, same series, 13 May, the 290 put short and bought the 282 under it. So now we have what we call a balanced butterfly with $8 on each side on the width. Okay, $8 butterfly, so balanced there. Now by doing this, you can see we brought in $258 from that credit spread. So that basically offsets almost that full amount of the debit cost here. So now we are into this trade with our risk of only $22. Okay? So $22 risk, and if it goes out anywhere inside of this, profit zone here, and if it was to go out exactly at the 290 strike on Friday, this would be up, close to, well, it'd be up over $700, $778 per spread, and that's a 35% return. Or you're risking $1 to make $35. Okay, so 35-to-1. So that's incredible kind of risk reward on that kind of structure. So going out today on the close, the put debit spread side, at 280 was up $152, but by adding the bull put credit spread here, the 290, 282, and bringing in 258, we added an additional potential profit to that trade, and it went out up $194 because the 258 short strike here that we had on the credit spread now went out closed at 216, so we brought in some money there. So just a great way to hedge, great way to increase return, and a great way to also increase your theta to make it more positive as well. So I hope this helps, and I look forward to talking to you on my next video updates. Good luck trading.